Thank you for coming to today's webinar, Overview of California SB 253 and 261. Your presenter today is John Scheidler. If you have any questions throughout the webinar, I kindly ask that you type them in the chat box and we will address as many as we can at the end of the webinar. We also encourage all participants to complete the survey afterward. Your feedback is greatly appreciated. If you would like a PDF copy of the presentation or the webinar recording, please contact us at webinars@omnex.com. John Scheidler is an environmental consultant with 26 years of experience who specializes in greenhouse gas management. He has extensive expertise in environmental, health, and safety management systems across diverse sectors, including oil, gas, coal, manufacturing, mining, metals, and transportation. Scheidler serves as a U.S. expert on ISO Technical Committee 207 Subtag 7 on greenhouse gas management. He holds certifications in greenhouse gas management validation and verification, and currently is helping to write ISO 14019, validation and verification of sustainability statements. Scheidler is based in Arlington, Virginia, and consults with clients worldwide. Now, without further ado, please welcome John.
Thank you, everyone. It's really a pleasure to be here. We conceived this presentation is in two parts. This week is the presentation of quantification of greenhouse gas emissions in accordance with the requirements of the Greenhouse Gas Protocol. And the reason for this is what the Senate Bill 253 requires for organizations for their 2026 reporting. We'll talk about the scope of the reporting. We'll talk about the principles, the accounting principles, and a lot of other information related to using the Greenhouse Gas Protocol as your frame of reference for reporting greenhouse gas emissions. Next week, we will also spend some time looking at the most recent updates to the California Senate Bills 253 and 261 from the regulatory angle. But if you have any questions about those two Senate bills and the state of the regulatory development, you can also put those in the chat, and we'll try to address those as we have time for questions. So with no further delay, let's get started on the accounting element. If I can make this work. There we go. So I'd like to begin with just a reminder of what the principles are of greenhouse gas reporting. This is not unique to the Greenhouse Gas Protocol. It's also found in ISO 14064 Part 1, for example, and other frameworks for reporting greenhouse gas emissions. So we have the 5 principles that are shown here on the screen. Consistency, accuracy, transparency, relevance, and completeness. These are all the objectives of greenhouse gas reporting, according to the Greenhouse Gas Protocol. Now, it just so happens that some of these principles have a little bit of tension. There may be some trade-offs from one to another. For example, we have the 2 principles of relevance and completeness. Relevance means that the reported emissions are relevant or significant, if you want to use that word, enough to be included in the greenhouse gas inventory. And you can see that there is a trade-off between completeness and relevance, because to use the example I like the most, you may be auditing a oil and gas company with millions of tons of carbon dioxide equivalent emissions. And the question is, should that oil and gas company go down to the level of completeness to quantify the fugitive emissions from refrigerants that are used in their break room refrigerators? Well, many people would conclude that that type of granularity goes beyond the principle of relevance, and that you may not have to report under the principle of completeness those refrigerator emissions. Another example I like to use is you have a corporate headquarters. It has some trees in the parking lot. And so should you report the biological sequestration of carbon in the few trees in your parking lot? Again, if you're not in the forestry business, this may not rise to the level of relevance in your greenhouse gas inventory, and you'd be perfectly well justified to leave out those removals of carbon dioxide. We have similar trade-offs between consistency and accuracy. Consistency means we want to report as close as possible the same emissions, the same scope from one year to the next, so that people who are reviewing the greenhouse gas inventories can make a valid comparison from one year to the next. But there can be some trade-off with the principle of accuracy. So just keep that in mind. These principles are not requirements, and they're not absolute. Principle of transparency sounds really good, but it has to be bounded by some practical boundaries. One of the most important elements of developing a greenhouse gas inventory is defining the organizational boundaries. And we know that Senate Bill 253 spends a lot of time talking about who is the reporting organization, whether or not subsidiaries have to report on their own or can be consolidated in a parent organization's reporting. From the Greenhouse Gas Protocol perspective, organizational boundaries are selected using one of two approaches. You can consolidate the emissions based on equity share, which is applicable primarily to oil and gas companies and electricity generating companies. Or the most common approach is control. You may have operational control over a facility. Perhaps it's a manufacturing facility. If it's a joint venture, one or the other organizations involved in the joint venture has to be selected for the operational control if that's the method you use. Another method is financial control. This takes the same principles of inclusion or exclusion that would be applied if you were the chief financial officer preparing financial statements for the organization. So operational control is the most common, and equity share is limited to a select number of industries where it's common to have multiple actors sharing a resource, such as a power plant or an oil and gas field. The Greenhouse Gas Protocol has very good guidance on these methods. And this diagram on the right-hand side from Holland Industries, a made-up company, illustrates how the reporting obligation would change depending on whether or not the organization used operational control, financial control, or equity share. I won't go into the detail here, but that's a very complete chapter in the Greenhouse Gas Protocol, and it can be very useful for companies who have selected one or the other consolidation approaches for their organizational boundaries. Now, we have regulatory programs in several states, and one of the distinguishing features of regulatory programs for greenhouse gas reporting is that they typically go facility by facility. And I suppose the reason for this is that state regulators were already in the business of regulating the emissions from an individual facility. And so they have extended that boundary approach for greenhouse gas emissions. Senate Bill 253 and the Greenhouse Gas Protocol are focused on reporting not at the facility by facility level, but rather by the organizational level. And if you are currently reporting under the California Mandatory Reporting Regulation or similar regulations in other states like Oregon, Washington, Colorado, and soon to be New York, or if you have reported to the US EPA under Part 98, then you're very used to the facility by facility reporting approach. One of the main differences at the organizational level, and this is how Senate Bill 253 is written, is that you're reporting now at the organizational level. This will include emissions from such things as corporate headquarters and vehicle fleets, jets even, that would be omitted in most cases if you're doing facility by facility reporting. In addition, not all state regulatory programs require the reporting of electricity consumed or other energy. Could be compressed air, it could be heating or cooling, what we call Scope 2 emissions, and I'll get to that in a moment, are not necessarily reported in a facility by facility reporting paradigm. So what that means for 2026 quantification is that if your emissions quantification approach is using a facility by facility approach, then you've got an expansion of the scope that is needed for this year. And those emissions, of course, will be verified next year. So let's review the types of emissions that are expected to be reported under the Greenhouse Gas Protocol and under Senate Bill 253. We can summarize this as Scope 1, Scope 2, and Scope 3 emissions. Currently, the 2004 edition of the Greenhouse Gas Protocol only requires the reporting of Scope 1 and Scope 2 emissions. However, Senate Bill 253 requires, starting this year, the reporting of Scope 3 emissions as well. And Scope 3 emissions are made up of your value chain, emissions. So these are emissions that are generated by other organizations, but are associated with the activity of your organization. The Greenhouse Gas Protocol has 15 separate categories of these value chain emissions: purchased goods, transportation, sold products, capital goods, and the list goes on, up to 15. The list is easily found in the Greenhouse Gas Protocol document itself. Scope 1 is what we call direct emissions. Typically, this includes the combustion of fuels, although depending on your industry, there may be process emissions. Steel manufacturers, for example, have process emissions of carbon dioxide typically. Paper mills will also have carbon dioxide emissions, and cement as well. In nitric acid plants, for example, the emission that is made during the process is nitrous oxide. Another type of emission that is direct is fugitive emissions of refrigerants. This would be the dominant emission source, for example, if you operate a cold storage facility or a grocery store. In these types of businesses, fugitive emissions of refrigerants are very, very significant. But if you go back to the oil and gas company, not so much. Their primary emissions are carbon dioxide and methane. So within Scope 2 emissions, electricity is the most common. The reasoning behind the separation of electricity into a Scope 2, or any other purchased energy for that matter, is that the emissions that it takes to generate this scope of emissions would not exist without customers. It's so, for example, a manufacturing company is going to make products. Yes, it's regulated a little bit by demand and supply, but as long as the factory is turning out products, it's going to have pretty much the same Scope 1 emissions. But in Scope 2 emissions, the consumer of that electricity is the one who is going to determine whether or not the turbines turn, or at a hydro facility or a natural gas independent power producing company. One of the trends of the most recent few years is the significant rise in the use of renewable energy, solar energy, wind energy, hydro. These are very low emissions or zero emission sources for electricity. And under the Greenhouse Gas Protocol, your reporting by market-based reporting is going to take those low emission sources into account. And that would dramatically reduce your market-based scope of the Greenhouse Gas Protocol. You're also required to report your location-based Scope 2 emissions. And basically that just means the number of kilowatt hours or megawatt hours that you consume from the grid. That's location-based. It's like the emissions that you have at your home, unless your home is off-grid, which is unusual. But for most people, they pay an electricity bill based on consumed kilowatt hours for the meter that is turning every time you are powering something with electricity. And the same thing is true with organizations. So under the Greenhouse Gas Protocol, you report two ways: location-based, based on the meter turning, and then market-based, based on your purchases of renewable energy, which reduce your organization's Scope 2 emissions. And these emissions can be very large. Very often they exceed the emissions, the direct emissions from an organization's equipment, of heating equipment or whatever. Scope 3 emissions are defined as the upstream and downstream emissions of the reporting organization. We give the examples here of purchased goods and services, transportation, and the list goes on for up until 15 categories. If you're an automotive manufacturer, one of your Scope 3 emissions will be sold products, the emissions of sold products. And so there you would be calculating the efficiency of your fleet of manufactured vehicles and quantifying how much the users of your products, take for example automobiles, will be generating in Scope 3 emissions. So that we sometimes refer to Scope 3 emissions as embodied carbon. And I'll show a diagram in the next slide that shows where certain countries, particularly the United States, is responsible for a lot of emissions that actually take place overseas. And what happens in this case is that manufacturing goes offshore, domestic emissions decline, but imported emissions increase. And so if you're reporting, or now that you're reporting on under Senate Bill 253, Scope 3 emissions, you will have to take account of those emissions. This is a very useful diagram because it shows the outsized influence on the reporting side of the United States and China. China is responsible for a huge number of greenhouse gas emissions. And then most countries, except for the ones on the far right there, are net importers of emissions. And the United States is the largest of those. So unless you're reporting under Senate Bill 253, you had to choose, do I report Scope 3 emissions or not? Well, many people would say that they're material to the organization, and that's a good reason for reporting them. Second, the Greenhouse Gas Protocol from 2004 makes the reporting optional. So many companies traditionally have not reported them. However, investors are increasingly looking for organizations to report Scope 3 emissions, and regulators are now following suit. So within Senate Bill 253, the fact that the Greenhouse Gas Protocol says that they're voluntary doesn't affect your obligation if you're reporting under 253 to report Scope 3 emissions. One of the arguments against their reporting is that it's double counting because the emissions are being reported also by the the organization responsible for the Scope 1 and Scope 2 emissions. But this is a known double counting. And so the argument is that, yes, it's double counting, but it's a way for interested parties or intended users, depending on the terminology you prefer, to get an idea of the total carbon footprint of an organization. And investors in particular are seeking this information because they're trying to evaluate the carbon risk of individual companies. They're thinking about stranded assets in a scenario where there is product substitution, or they're looking at regulatory risk that could come about by some future cap and trade program or carbon border adjustment mechanism or something like that. One of the most influential reporting standards of the last few years is from the International Sustainability Standards Board, or ISSB. These standards, S1 and S2, were published in 2023, and they apply in practically every country in the world except for the United States. The reason for that is that they were published by the IFRS, the International Financial Reporting Standards Board, which publishes the standards, the financial accounting standards that companies around the world use, except for the United States. Here we use generally accepted accounting principles. We have our own set of standards. They're very similar in many respects, but they're slightly different. And for this reason, the ISSB financial reporting standards don't apply here. And any reporting using ISSB S1 and S2 would be voluntary on the part of a company that was obligated under Senate Bill 253. There's a nuance here, though, and that is that California has acknowledged ISSB S1 and S2, particularly S2, as a reporting framework. The ISSB S2 standard was built on the framework of the Task Force for Climate-Related Financial Disclosures, TCFD, which is another method under which companies that are required to report under Senate Bill 261 can report their financial risk, their climate-related risks. So ISSB is significant for that reason. It's also taken over the maintenance of the TCFD. In other words, the TCFD was published in 2017 based on a mandate from the Financial Stability Board that was created after the financial collapse in 2008 and 9. And they've basically gone out of business. So the standards from the ISSB are the current game in town. And I just read in today's trade publications that the ISSB is starting an S3 standard on biodiversity, and they should have an exposure draft by probably the third quarter of this year. So what is the purpose of this ISSB S2 climate-related disclosure standard? Well, they're targeted to readers of an organization's financial reporting. It's intended by the ISSB and the IFRS that organizations integrate their financial reporting with their other risk reporting. And so that gives the users of those financial statements an idea about enterprise value based on an investor, for example's view of the potential effects of climate-related risks and opportunities. It also allows readers of integrated reporting standards or statements to understand where vulnerabilities may lie. A lot has been made recently of the rare earths, for example, that are critical for some industries. We often talked in the past about critical minerals and conflict minerals. So these are things that could be disclosed under the reporting requirements of S2. And then the third thing is transition risks. So S2, you can summarize S2 as dealing with, first of all, physical risks that could have an impact, a financial impact on the organization, and transition risks. And these transition risks involve what the company's strategy is. Is it planning on becoming net zero? How is it going to do that? Will that strand some assets? Will that result in some product substitution? How's that going to work out? There could be winners and losers in industry. And so these are the matters of climate-related risk and opportunity reporting that are the subject of Senate Bill 261. So I've just talked about physical risks and transition risks and integrated reporting. So this is the trend internationally. We've had a little bit of backsliding in the United States based on current governmental priorities. But I think many organizations would accept the notion that the pendulum that swung back can also swing back the other direction once there's some kind of political realignment in this country. And in any case, you have the requirements of SB 253 and SB 261, soon to be joined in New York by a similar type regulation. And you have investors who want to have this information. So it's probably a good thing to think about it, even if the regulatory environment in the present period is somewhat relaxed. So back to the boundary question, we talked earlier about the organizational boundaries. Let's talk briefly about reporting boundaries. Reporting boundaries are not exactly the same as organizational boundaries. Organizational boundaries tell us from which facilities, from which fence line, if you wish, are emissions being reported. Organizational boundaries identify the sources of emissions and the types of greenhouse gases that are affected. So these direct emissions include, I've listed the chemical names, but it's carbon dioxide, methane, nitrous oxide, nitrogen trifluoride, sulfur hexafluoride, and hydrofluorocarbons and perfluorocarbons. So hydrofluorocarbons are mainly used in refrigeration. Perfluorocarbons are used primarily in the manufacture of aluminum, but also some medical devices, some monitoring equipment. So if you're a hospital, you may have perfluorocarbons that were not on your radar screen. Chlorofluorocarbons, CFCs, are not included in the Kyoto gas category because they're regulated under the Montreal Protocol. And in most advanced countries, they've been virtually eliminated in any respect. I recently had a client that had one piece of refrigeration equipment that still used Freon, and pointed out to them that its reporting was optional and it would have to be under a separate category because it's not theoretically or by convention, it's not a greenhouse gas according to the Kyoto Protocol and the successor Paris Agreement. The Greenhouse Gas Protocol requires reporters to report in tons of each gas that it emits, as well as in tons of CO2 equivalent. So you would be expected to, if you're an oil and gas company, for example, to report tons of methane and then use a global warming potential to convert that into the normalized carbon dioxide equivalent. Removals are somewhat different. This is when biological organisms like trees, grasses, other biomass sequester CO2. And these are called removals. They're reported separately from carbon dioxide or from emissions, excuse me. And we don't net them. In other words, you don't subtract removals from emissions. You report each one separately. And you report removals in carbon dioxide equivalents, which is basically converting it from molecular carbon to the gas carbon dioxide. As I mentioned earlier, we have two methods that we must use to comply with the Greenhouse Gas Protocol for Scope 2 emissions: location-based and market-based. And these other points I think I made when we discussed that earlier. Scope 3 emissions, as I've said a couple of times already, are categorized 15 different ways by the Greenhouse Gas Protocol. And for voluntary reporting, you were able to choose whether or not to report them. And these 4 bullets provided the reasons that an organization could use to report them or not. But now that they're mandatory under SB 253, I would go back to the basic greenhouse gas principles of accounting: completeness and relevance. So you might be able to argue that some emissions are not relevant, but the principle of completeness would suggest that you report all that apply. This is one of my favorite diagrams from the Greenhouse Gas Protocol. It's a great visual that identifies all 15 categories of the Scope 3 emissions and divides them into upstream activities and downstream activities. It's a very visually based and easy to understand diagram. You have to look pretty hard to find this updated one that includes nitrogen trifluoride. It is, if you do a Google search, you will find it. But it was prepared after the last update to the Greenhouse Gas Protocol. So it's not in most of the published versions. And by the way, the Greenhouse Gas Protocol is under revision right now, but I wouldn't expect any update of those standards to be available to review until 2027 at the earliest. So what is the basic approach for reporting emissions at the organizational level? One of the first steps that you need to do after determining your organizational and reporting boundaries is identifying greenhouse sources and sinks, selecting quantification approaches, and then calculating greenhouse gas emissions and removals. One of the chapters in the Greenhouse Gas Protocol asks you to select a base year for comparison against future greenhouse gas inventories. And that's typically the first year of your reporting. So the principle of completeness would be include all relevant greenhouse gases, classify your sources and sinks according to scopes. And sometimes it's a little bit difficult to decide whether an emission is scope 2 or scope 3. So be aware of that. And justify any exclusions of sources or sinks. This diagram is something that we developed, and it's not a requirement to use anything like this, but if you're interested in mapping a complex process, you can use something like this, an input-output diagram, to understand where your emissions are. And the facilities management people may already have something like this. This allows you to map the emissions based on inputs and outputs and emissions and discharges. So could be a useful tool. As far as quantification approaches are concerned, the most common one is the use of activity data multiplied by an emission factor. So for example, you may know how many liters or gallons of fuel you consumed, or the number of tons of coking coal introduced into a blast furnace. And then you look for an emission factor from an authoritative source. One of the ones that we use in the United States and Canada is the Climate Registry. They update it every year. And we also have much older emission factors that are produced by the Intergovernmental Panel on Climate Change. So we recommend using more localized ones, preferably, and then the IPCC as a backup. In some industries, For example, electricity generation, nitric acid plants, and a few others. Direct measurement is possible using continuous emission monitoring systems, but that's the exception rather than. So once you've identified all the sources, selected a quantification method, identified the emission factor, you can start aggregating your emissions into scopes. You may also want to aggregate them by facility. So facility and scope, and then consolidate into a larger organizational inventory. Anytime there is fuel consumed, or practically any time, but there's fuel consumed in vehicles, they're going to be combustion byproducts. So that means that most organizations will report carbon dioxide, methane, and nitrous oxide at a minimum. And depending on whether you're a process industry or an electricity distribution company, you may have some of the other gases. There are forest companies, particularly in California. Northern California has a lot of forest companies, and they use growth and yield models to quantify merchantable timber, which is the number of board feet of timber in a tree. But interestingly enough, these same growth and yield models can provide us with the amount of carbon in the stem of the tree and the branches and roots, depending on what the reporting requirements are. So we have tools for estimating carbon sinks from forest inventories, and that's something that Omnex FuturePass deals with on a regular basis. So again, you're going to aggregate your greenhouse gas emissions and removals, report them separately, use global warming potentials that are appropriate. And they have differing ones, for example, for fuel consumption, depending on whether it's mobile combustion or fixed combustion, so you have to be careful. The Greenhouse Gas Protocol expects you to use a 100-year time horizon for global warming potentials, even though other shorter global warming potentials exist, but use the 100-year one for SB 253 reporting. Now, you can include in your report shorter ones, especially if you're a heavy emitter of methane, but it's not required. Every organization needs to have a base year recalculation procedure so that you can make adjustments to that base year depending on whether or not you acquired or divested yourself of a facility or merged with another organization. This ensures that the adjusted base year will be comparable for emissions going forward. And then the final trigger there is if you think you materially erred in the calculation of your first base year, you can retroactively correct it. What you don't do is adjust the base year based on organic growth or decline. You just have to live with those extra emissions if you're growing. And if, unfortunately, you're not growing, you're declining, that doesn't affect the base year either. So there are reporting requirements in Chapter 9 of the Greenhouse Gas Protocol. And this list of bullets provides all of the different requirements for reporting of the reporting entity. So I'm going to stop here. Thank you. We have a few minutes left for questions, and glad to have them. Andrew, do we have questions?
Yes, John. We have a question asking, completeness seems very subjective. Couldn't an auditor disagree with your judgment?
Yeah, yes, that can happen. So again, it's a built-in trade-off between the principle of completeness and relevance. And let me give you a rule of thumb. So if you identify an emission source, let's just say welding gas as an example, and it's less than 0.5% or 0.25% of your total greenhouse gas emissions, that probably is going to fail the relevance test. But some people would say that your total of all non-relevant sources should probably not exceed 1%.
Okay. Let me see if we have any other questions. We have one question. How long does a third-party verification take?
That depends on the complexity of the organization and the types of emission sources. Now, I can give you a range. We have customers and this is at the limited level of assurance. We have customers ranging from below $10,000 to above $100,000 in annual verification costs. Well, you can imagine that the organization that spends as much as $100,000 on limited assurance is a very large organization with very complex emission scopes. And so that's one thing. The second thing is limited assurance exists on a spectrum. And the spectrum ranges from somewhere neighboring no assurance to somewhere approaching reasonable assurance. Our client with the extensive assurance engagement each year is much closer to reasonable assurance, but they don't want to pay for site visits to 5 continents, and but they want very in-depth limited assurance. So we provide that service to them. Most of the organizations that are going to be reporting under SB 253, well, first of all, they're $1 billion or more in total revenue. But my guess is that the limited assurance verification will range somewhere neighboring $10,000 to maybe double that, depending on how complex their sources are. Office-based organizations, organizations where electricity emissions exceed the direct emissions are much more likely to be at that lower end.
Okay. And what data is checked during the third-party verification?
Well, it depends on the level of assurance. Under limited assurance, we check the quantification methods for sure. We check the emission factors. We check the completeness based on industry benchmarks. The principle of limited assurance is that the assurance is provided at the overall level of the organizational inventory. In other words, we don't go down to the source level in limited assurance. In reasonable assurance, we track specific sources that are material to original documents for um, the quantity of fuel consumed or some other indicator of the emissions. So reasonable assurance, this is the kind of, you can take it to the bank, these are your emissions. Limited assurance provides a meaningful assurance for the intended user, but it's primarily executed using what we call agreed upon, not agreed upon, analytical procedures and inquiry. Inquiry is basically interviewing people to make sure that the inventory was properly performed. And then analytical procedures would mean comparing one year to a prior year, doing some tests to compare reported emissions to benchmarks and things like that. So those are the
Okay.
primary tools we use in limited assurance.
Is there any specific requirement on who can do the third-party limited assurance, such as a CPA or something like that?
Well, according to SB 253, we don't know. We would, Omnext Future Past would like accredited third parties, such as ourselves, to be authorized. It may be the financial accountants would like themselves to be authorized. My guess is that when ARB creates a new regulation in 2026, they will probably allow both of those types of organizations, the accredited ones under ANAB, the ANSI National Accreditation Program, possibly the accredited ones under the mandatory reporting regulation in California, and probably the financial accountants. But I don't know that. Nobody knows because they haven't released the draft regulation yet.
Okay. And for a multinational company, does the limited assurance need to include a facility in California?
No, site visits do not require site visits. They're optional. So as long as we can gather the information from the organization that we need, we don't need to go on site.
Okay. I think that's it for the questions. So thank you everyone for your time. And again, if you want a recording of the webinar or the PDF file of the webinar slides, please email webinars@omnext.com. And otherwise, have a great day, and hopefully we'll see you for the next one.